Two of the biggest problems in the investment industry are comparing the fund to a wrong benchmark and the fund not living up to its expectations. When I say expectation, the fund not doing what's stated in the fund's fact sheet's objective. To showcase these two problems, I'm going to take a pure value fund issued by Aditya Birla Sun Life. Let's tackle the first problem now. So, the wrong benchmark. When you come into this tool, we automatically suggest a benchmark that we calculate among the set of 40 to 50 benchmarks that we have. We don't go by what's stated in the fund's fact sheet or what's suggested by the fund manager. The reason being is whenever you go into the fund fact sheet or suggestion or the suggested benchmark, in their website, you fund managers always pick a benchmark that is inferior to their fund to showcase that it's outperforming, right? And to showcase that your fund is superior, you pick an inferior benchmark. And that's exactly why we don't go by the benchmark suggested by the website or suggested by suggested in any fund fact sheet. So here it's a pure value fund, so we are picking a small cap value index. We will get into the small cap part, which is quite interesting in this case. Before we go into the second problem, which is the fund not doing its objective, let's quickly compare its performance. So one thing that is clear is that this is an active fund, but you can see that the trends are pretty much the same. Although it has quite outperformed in a lot of years since its inception, right? So it has always been a bit above than the small cap value index which is the benchmark that we have chosen, right? So overall, I think the total return of the pure value fund has generated 477 versus 426, right? So it's a healthy 50% extra return that you are getting from this pure value fund, and almost like a 0.9% on an annual basis, right? On an annual return basis, you're getting 0.9% in terms of returns. So let's get into the second problem. So first problem, as I mentioned, right? So the fund manager of this the fund. NIFTY 500 has been picked as the benchmark by the fund manager for this fund, which is clearly not the correct benchmark to compare this fund against, because this is a pure value fund. So going into the second problem, which is the fund not doing its stated objective. So when you read this fund name, you expected this to have pure value, right? That too, you expected nothing but value, right? But the problem with this fund is that although it's called as pure value, it has size exposure as well. So you can see that it has consistent since its inception. It has a consistent size exposure, which means that it has heavy lot of stocks in the small and mid cap space. So from a risk perspective, value factor is not driving the risk, size factor is driving the risk. So this is something that you might not have expected this fund, because the name tells you that it's a pure value fund, but it's actually is a pure size fund or a pure small cap fund. And that why though if we go back to the benchmark that we picked, right? I mentioned that we will get back to the small cap part of it in a bit, right? So since this has small cap exposure as well as value exposure, so that's why we are picking a small cap value exposure, that is a small cap value benchmark, to compare this fund against, and not the benchmark suggested by the fund fact sheet. Now we have compared, or we have discussed two main problems, right? We'll quickly review this fund itself in terms of outperformance, whether this fund has done well. So as shown in the first chart itself, right, the fund has generated outperformance of 50%, which is a healthy margin there, and it has outperformed 7 out of 12 years and has generated alpha again, 7 out of 12 years here. Now I will showcase something that's a bit interesting that you might not you might not even have thought about this when you're looking into this fund. So when you're going through this fund, right, you were kind of expecting it's like a value fund, so you should be comparing this value fund to set of other value funds in the market, right, to look at whether this fund has actually generated any alpha or outperformance compared to its peers, right? But when you get into the breakdown by market capitalization, it kind of tells you a story here, which is it has a 40% in large cap, 40% in small cap, and about 15% in mid cap. So if you have analyzed any flexi cap funds, it kind of looks similar to this. So it kind of created a doubt. So before getting into, before comparing this fund to a flexi cap fund, what I did was, I went to cheaper peers to see whether there are any other funds that are giving similar exposure as the pure value fund, that is the Aditya Birla pure value fund, but with lower fees. To my surprise, there are about you know 6 funds that are giving you similar exposure as this fund, but with significantly lower fees. Especially the ITI FlexiCap fund. We already covered the FlexiCap part of it, right? So you're getting same exposure as this pure value fund, but with significantly lower fees. That's another good aspect about coming to this stamp, is that you are not comparing this fund based on its name or based on what the fund manager is claiming it to be. You are comparing with the essence, with the underlying exposures of this fund. So let's take this to asset comparer and see the performance of these funds, and also compare its expense ratios as well, right? So when you get into this analysis, right, you look at by starting cumulative returns, right? So as mentioned in the previous analysis, you can see ITI and the Aditya Pure, value fund. They are pretty much doing the same thing, right, in terms of performance. Since March 2023, it literally mirrors. But the funny part is both the names are completely different, right? So here you're calling this as a pure value fund, whereas here it's called as flexi-cap fund. But the underlying exposures are pretty much the same. So if you look at the blue bar and the green bar, right, the exposure to the equity market, which is the Nifty 50, they're almost close. And if you look at the size exposure, again, zero point 0.7, zero point 0.6 compared to other things which are a bit lower, right? So that's why you have similar performance. But the good thing about the ITI's FlexiCap is you're getting it for a fraction of the cost. It's almost 5x reduction in the cost, right? So that begs the question: why should one pay 1.1% to the fund manager when you can easily get it for like 0.2%, right? Something to think about there. I think we have come to the end of the video. What we have looked at in this video is we have discussed 2 main problems, right? One is comparing a fund against a wrong benchmark, and the fund not living up to its expectations. So we initially saw that this fund should not be compared against Nifty 500, which is suggested by the fund manager, but in fact it should be compared against the MSCI small cap value benchmark, which is an appropriate benchmark, right? So when you compare it to an appropriate benchmark, obviously the outperformance will be lower, and which is what you need, right? When you're deciphering or when you're analyzing a fund, you need to get to the truth as quickly as possible. The second problem is the fund not living up to its expectation, right? Although this fund is called as pure value fund, actually the size factor is driving its risk. So where is the value exposure here, right? I think that sums up the video. Thanks a lot for watching. See you next time.